Today we're going to talk about how to quickly analyze an investment property. My name is Rod Khleif, and I'm host of the #1 real estate podcast on iTunes, Lifetime Cash Flow Through Real Estate Investing. I'm also author of the book, How to Create Lifetime Cash Flow Through Multifamily Properties. Now, quickly analyzing a commercial property, it's not only possible, it's actually pretty simple if you understand a few key terms. When you're evaluating commercial real estate, particularly multifamily real estate, there's just a few things you need to know. For example, you need to know how much money the property is going to make. You want to know, what the return is going to be on the investment. You want to know how does that property measure up to other investments. Now, what I'm going to show you today will help you with all of that. First, let's talk about 4 key terms that you need to know. The first term and that you need to know and understand, I think is probably the most important, and it's really simple. It's the net operating income, or the NOI as it's known in the business. And what it is it's the gross income on the property, less the operational expenses on the property. Now, gross income would be all the rents on the property, maybe income from a laundry facility on the property, maybe you're getting storage income. So all that income's included in the gross income, and then less the operational expenses. Now, and that's the NOI. Now, just so you understand operational expenses, those include things like property taxes, insurance, property management, repairs and maintenance, advertising. Now, those are operational expenses, but the operational expenses do not include the mortgage or debt. We're going to talk about where the mortgage and debt comes in a minute. Now, I'm also going to give you an example of this so you can see after I'm done describing these terms, you'll understand this much better. So again, the net operating income is the first thing you need to understand. I think it's probably the most important thing. And again, it's the income less the expenses, operational expenses, that's the NOI. Now, the reason this NOI is so important, because anytime that you're evaluating a property, if you can get the NOI increased, it's an exponentially huge impact on the value. When it goes up, so does the value, and those increases. Literally a $10 increase on a 100-unit property, and if you calculate in a cap rate, which I'm going to talk about in a minute, it can be a $200,000 to $300,000 increase in value, $10 a month. That's the exponential value of raising your NOI. And there's 2 ways you raise the NOI, by increasing income or reducing expenses. So anyway, now you understand the NOI. Now again, don't confuse the NOI with gross income. You have to subtract the expenses first. So the next barometer on a property is cash flow. And cash flow, for our purposes, we're going to define cash flow as the NOI minus the mortgage, okay? And you're going to do this on an annual basis. So this will be the NOI annually and the mortgage payments times 12, okay? That's the cash flow. Now, the next important term you need to be familiar with is cash on cash return, okay? If you want to know how fast your money's moving. The cash on cash return tracks the velocity of your money, so how fast it's growing. And it's going to show you how fast you can get 100% of your money back. So if you have a cash on cash return, for example, of 25%, you basically get your cash back in 4 years. So the cash on cash return is calculated by the cash flow, okay? So again, the cash flow is the NOI subtracted by the mortgage. That's the cash flow. And the cash on cash return is determined by the cash flow divided by your down payment in the property, okay? All the money that you've invested in the deal, the down payment, the closing costs, and maybe any initial expenses. And again, I'm going to show you an example of that in just a moment. And the last term that you need to understand is the cap rate. Now, the capitalization rate, or cap rate, it's used in the industry to evaluate different types of properties. It basically shows you what the return on your investment would be if it were an all-cash purchase. Now, the cap rate's going to change based on the type of property that it is, what area it's in, how old it is, how risky the investment is, and it's going to tell you what sort of a return you can expect. Now, it's a market-driven number that you use to evaluate a property and to determine the value. So again, the capitalization rate is the rate of return on a real estate investment property based on the income that property is expected to generate if it were a cash purchase. So it's really used to estimate the investor's potential return on his or her investment. Now, the cap rate can be calculated by dividing the net operating income, NOI, Divide that by the purchase price. And that will equal the cap rate. Okay? All right. Okay, so cap rate equals the net operating income divided by the current market value. NOI, just want to show you this again, market value or purchase price, and that equals the cap rate. Okay? Now after you've done this a couple of times, you're going to get it, but the lower the cap rate number, the higher the price and less risk. The higher the cap rate number, the higher the risk and the lower the price, okay? So, but the higher the cap rate number, the higher the return, but that equates to risk. Now, lower cap rates are going to be in better areas, and again, less return, higher prices. But you can't properly evaluate a commercial property until you understand this process. So let me show you an example of all of these numbers and calculations in action so you see how simple they really are. Okay, so let's assume a purchase price of $350,000, okay? Just for example purposes. Now let's say that we're going to put a down payment of $80,000 on this property, okay? And then when we calculate the debt, our mortgage payments total up to $18,000 a year, okay? And again, we're just using these for number's sakes. So let's say the gross income on the property, remember from all sources, gross income from all sources is $48,000. Let's say the operational expenses are $17,000. So we've got income and expenses that give us an NOI of $31,000. Remember, net operating income, $31,000. Now, we take that net operating income and we subtract the debt, the yearly debt. And again, this is all annual. Remember, these are all being done annually. We subtract the debt of $18,000 and we have a cash flow of $13,000. Okay? You following me? I know I'm doing this kind of fast. I'm going to do this again. Purchase price $350,000, down payment of $80,000. The mortgage payments for the year are $18,000. The gross income on the property for the year, okay, again, for the year is $48,000. The operational expenses for the year are $17,000. That leaves an NOI for the year of $31,000, okay? Again, just want to remind you these are all annual. And then your debt payments for the year are $18,000. Cash flow is $13,000, okay? Now, to get the cash on cash return, we have to divide that $13,000, which is the cash flow, by the $80,000 that we put as a down payment, okay? And we have a 16% cash on cash return, which is pretty respectable. Now, to calculate the cap rate on this property, we're going to divide that NOI, that net operating income of $31,000, divide that by the purchase price of $350,000, and we have a cap rate of 8.8%. Now, I will tell you, let me write this down. I won't buy a property unless I can get a cap rate of at least 8% or the ability to get there very quickly with maybe a small bump in rent or a decrease in expenses. I won't buy a property unless I can get a cash-on-cash return of at least 12%. So this is pretty simple, right? Now watch this a couple times if you're not totally clear and practice it on a couple of properties, and I promise you're going to have it. Now I hope you seriously consider multifamily properties as your ticket to lifetime cash flow. Now my 200-page book that I mentioned earlier, titled How to Create Lifetime Cash Flow Through Multifamily Properties, it's still free. Yes, free, totally free. And I'm going to put it on Amazon soon, and then I'm going to have to charge for it. But if you'd like a free copy, just click on the link in this video or below this video, and you're going to be very glad you did. It's really like a textbook for this business, every aspect of it with no fluff. Now remember, there's no investment like multifamily real estate for stability, cash flow, and incredible tax benefits. If you've got any questions or comments about this video or anything else in any of my videos, please leave them below. We love hearing from you guys, and we're very responsive. I'm Rod Khleif, wishing you incredible passion and massive success in your business and in your life.